Welcome back, folks. This discussion is going to be with commodities. So everything I'm going to be talking about here should be viewed in the light of a paper trade only. It's important you read these disclaimers. And as a reminder, I'm not a licensed commodity trade advisor. Everything here is for informational purposes only. Okay, folks, July 2017, ICT Mentorship Mega Trades. The first lesson we're going to be talking about the commodity market. Okay, first, what is mega trades and what are they? And one of the first things I learned from Larry Williams was this notion of finding these big moves that take place every year. And basically what a mega trade is, and I didn't coin this term, this is something I picked up from Larry Williams, obviously. It was his catchphrase he used for him. But it's a large price swing or trend that can produce massive potential gains that when compared to relative markets, outperforms them all. Now, they're easy to spot historically in your price charts. You can see them every single calendar year. These moves have huge institutional sponsorship, and it's coupled with strong influences from actual supply and demand factors that fuel these moves. So yes, while I usually snub my nose at supply and demand as a technical approach to trading, supply and demand as it relates to commodities is an absolute reality. You have to have a good feel for what the supply and demand factors are for a commodity to have any measure of success. Now, when we talk about commodities, obviously there's a number of commodities that we can choose from, but one of the things I want to talk about, since we're talking about this particular asset class now, is that should you be a commodity specialist? Well, when following the commodity markets, in my opinion, it's best to avoid being a specialist or one market trader. The reason why I say that is because a favorite commodity can provide plenty of setups to consider, but it might be a sleeper while other markets are on fire. In other words, if you're looking at one commodity and that's the one you make your bread and butter setups on, if you're just looking at that one, you'll never be able to find the bigger moves that take place that have extrapolated price swings because you're only focusing on one thing. Now, there's nothing wrong with having a special asset class or a special market to do your bread and butter setups. But if you limit your scope just to that, you're really discounting one of the best opportunities for you to get in here and, number one, improve as a trader, get a better feel for the general market. But the bottom line is if you can be profitable trading these types of moves, why wouldn't you want to? And commodities as a whole offer a very small universe of markets to analyze to seek mega trades. Kind of like the Forex market, I choose to follow just a few pairs of the majors cross with the dollar, and it takes a lot of the ambiguity away from what I should be doing. If there's not a signal that's very clear, I'm not doing anything. If there is a time of year when I believe that a mega trade or a large move is going to take place, then I'll be doing my analysis across the entire spectrum of that asset class. For commodities, you'll be doing it with several different sectors. Okay, the first category that we're going to be looking at is the agricultural markets. And we're going to first look here for mega trades. And these are markets that feed the world. And as a result, they will have even greater supply and demand factors that move them. Droughts, insect damage, frost, or bumper crops will have an enormous effect on prices in these markets. Now, the grain markets, we're going to take a look at the grain complex. And the first on the list is soybeans, soybean meal, soybean oil. Both meal and oil are derivatives of the soybean itself. Wheat, corn, oats, canola, and rice. Now, oats and rice I traded back in the 90s. It's a rather thin market. You can get hurt in that if it starts to do limit moves. And I did have the unfortunate experience of being caught in some of those things, and it's not fun. So I'm going to advocate here not even to follow these three specific grain markets. When I was looking at the commodities years and years ago, back in the 90s, I would use these thin markets to look for drops in open interest to more or less build the idea that I thought that the grain markets as a whole would go higher or lower based on that. And sometimes it worked and sometimes it didn't. So initially, as a new trader, I built a lot more significance around that in my ignorance, but now I just simply don't even consider these three particular grains to be watched at all. But I include them here because of completeness sake. If you look at the grain complex as a whole, as I taught earlier in the mentorship, for the grains, I just like to follow the soybeans themselves, Chicago Board Trade wheat, and Chicago Board Trade corn. So it's really only three grains that's in that sector. Okay, and the livestock meat complex is going to be live cattle, feeder cattle, and lean hogs. It used to be pork bellies in this sector, but they discontinued trading those. Moving on, we're looking at the softs. This is a food group. So we have coffee, cocoa, sugar, and orange juice. That brings us up to 10 commodities so far in the agricultural. And in the fibers, we'll be looking at cotton. So that's 11 markets in the agricultural markets. Okay, the next area of opportunity is found in the financial markets. And this is a group of markets that are hard in nature and industrious. So industrial supply and demand factors are going to move these commodities. So wars, economic drivers, interest rates, imports, exports will have a greater impact on these kinds of commodities. Okay, the first one is going to be the metals market, and it's broken into two categories: precious metals, which being the gold market, silver market, palladium and platinum. Palladium and platinum, again, I had experience trading both. They're very thin, very, very thin. And I include them here for completeness sake, but just as a general rule of thumb, don't want to trade them. And in industrial metal, we have the high-grade copper. So in essence, we have three metals to look at: two precious, one industrial. So gold, silver, and high-grade copper. So we have a universe now. It's not growing exponentially, just adding a few more at a time. And we have the energy sector next, and we're looking at the markets that make up that energy sector, being crude oil, heating oil, gasoline futures, and natural gas futures. Now, admittedly, I don't have any experience trading futures contracts in natural gas, but in recent years it's been very active, and I know folks online that have traded it and done very well with it. Not specifically with my content, but I do know other traders that have made their living trading natural gas futures. All right, so fundamentals, they matter for this asset class. So commodities require a measure of fundamental consideration in our analysis. We do not have to wade through dry, boring crop reports or cattle head reports. A simple newspaper headline might be all that's needed to draw a fundamental conclusion. Now, what do I mean by that? Well, the idea of a market that has been quiet for a little while and suddenly there's a discussion by way of a headline. For instance, back in the 90s, there was a specific parasite that was supposedly infecting the crops in the U.S. And between that, the drought, and the heat waves that were going on, all the grain markets went into a premium market, and it just became like vertical, straight up runs on wheat, soybean, and corn that 1994-95 time period. And there was a lot of opportunity on the upside as a result of that. ahead of all of those big moves, there were headlines that suggested that there may be trouble looming for those particular crops. And it was mainly around the drought, the dryness in the breadbasket, if you will, the U.S. Um, and there was this, and for life of me, I can't recall what that parasite was, but there was uh, some kind of a bug that was trying to eat and damage one of the crops. And whenever you hear that type of stuff, and it's in the middle of summer, it's just like throwing gasoline on a fire. It will ignite all kinds of buying, and the grain markets just went vertical in the mid 90s as a result of all that. And one of the things I like is looking at Commodities Magazine, Futures Magazine. They have a little area in that magazine that's basically like the hot commodities right now. And it's almost uncanny how they always talk about them once they have been moving for a while. And if you do any analysis on them, they're going to talk about them as this is the hot market right now, right at a time when it would be at a point of reversal. And true to form, that's what ends up happening. So if we see headline news, or if we see um, special focus on specific commodities, saying that they're hot commodities, or these are the ones to be in right now, and we can look in the chart and see they've been moving for a while. That tends to be a really good condition for mega trades to form. The reason why is because it builds in an idea of sentiment, and whenever there's an extreme in market sentiment, whether it be extremely bullish or extremely bearish, those are wonderful contrarian signals. And if we can get those in a time when there's a overlap of technicals suggesting the same in terms of directional bias, um, it's a really wonderful opportunity and a real sweet spot for you to be as a trader. Okay, the fundamental starting point. Obviously, you've seen me teach this before, but it has to be in here for completeness sake. A quick and easy first step is to consult the delivery month closing prices. So you can go into barchart.com. If you have access to like Wall Street Journal or Investors Business Daily, just look at the delivery contract months, and you can see the closing prices. And what you're going to be doing is you're going to be noting any commodity that has a premium over a distant month. And as the months go out, again, they should be more expensive. But if it ever reverses and it's more expensive now, this delineates the premium is in the nearby months, whereas it should be in the distant months. This will be our primary search every year. We go into the marketplace looking for these conditions because they are the common ingredient for explosive bull markets. Markets tend to have longer periods of going up and explosive price action when there's a premium. When there's a lack of a premium, it takes very little time to drop in those markets. But we're looking for conditions when the market is predisposed to go higher, and we've already arrived at that by other technical analysis that you'll learn in your top-down analysis templates in August. But I'm giving you the general points in this teaching how to go about looking for mega trades, because you're going to get a homework assignment at the end of this teaching. But premiums are going to be a common denominator for explosive vertical parabolic price action moves that go higher, well beyond higher than you've ever imagined the move would go. Those are really fun to be a part of. They can be scary the first few times you get in them because you want to get out. Everything in your being says get out, but you want to hold on to them because they can go way farther than you ever thought they were going to go. Now, we don't need or require a premium to be in a bullish commodity or to deem it a bullish commodity. It merely adds to the likelihood of a strong price rally in the sense that bull markets are not all equal. A commercial bull market is a market that goes parabolically vertical, and they both can start off the same. Whereas a carrying charge standard bull market, where it goes up, down, typical stairway, that's not what you see in a commercial bull market. Commercial bull market with a premium, where the nearby months are selling at a higher price than the distant months, they go parabolic and very quickly cover a lot of ground, and they do so in short order, very quick. Um, it may take many months for a long-term carrying charge bull market to come to fruition or complete or go to a higher time frame objective. not when there is a premium. It can do it extremely fast. It can do it very energetically, and it's very fast. And that's a very fun market to be in when it's like that. Okay, dollar-based analysis. Now, generally when the US dollar is declining, this allows commodity prices to rise. And conversely, when the US dollar rises, this pressures commodity prices lower. Now, I say this because that's the general rule of thumb, but general thumbs are always panaceas. So there can and will be periods lasting as long as a year when commodity prices and the US dollar move in tandem or in the same direction. And there's no way around it. I don't have a secret science behind it where I can crack that code. You just got to accept the fact that we can never be 100% accurate, and therein lies the risks. Past performance is indicative of future results. We all know this. It's spoken in all the disclaimers, and anyone that reads out their disclaimers, audibly, they always say it. Same thing. Past performance is not indicative of future results. Everything I'm sharing here now are things that I've observed and picked up over 24 years now coming up, where there's just a massive amount of probability for certain things to take place. And while they are historically and statistically proven that they are likely to occur, does not mean or to imply that you should put money on them, because I'm talking about it here. When you do these studies and exercises, it's meant to stimulate your overall general market aptitude. But if you choose to trade on these ideas with live funds, that's entirely up to you. I don't want the glory for it. No, I surely don't want the shame for it when it doesn't work. I'm basically encouraging you to use these tools and these concepts to build a greater understanding of your price action analysis and general market condition. Okay, sector group leaders. When we are expecting higher commodity prices in general, we will seek to filter those markets that exhibit very bullish characteristics. When we are expecting lower commodity prices in general, we will seek to filter those markets that exhibit very bearish characteristics. Now, there can be opportunities to be contrarian in either of the conditions explained above, but to keep things simple, we're going to assume that we understand when the dollar is going to go higher, when the dollar is going to go lower, and we're going to use that as our basis. Now, there's other things you're going to learn in August to help you fine-tune a directional bias and also know specifically what you're reaching for, what concept, what type of trading pattern should lend well in that condition. But for now, I'm going to speak in broad brush terms because it'll help build the idea when we go into August. Those PDFs, you'll have a little bit more understanding, and that gap will be bridged quicker because of this teaching and this whole entire month's teachings, actually. But if you look at this chart here, it's a overlay that I actually created to show what I'm going to show you in the second slide after this one. But I want you to take a look at the wheat market. The wheat market is the little bit darker line, and the lighter line is the soybean market. So when we're looking for commodities to rally as a whole, while the dollar index ideally should be going lower or about to trade lower, that gives us a reason to anticipate higher prices in commodities. Now, while this isn't a mega trade per se, this is how they start off. So that's why I'm showing it to you. And this is actually as of right now, the time of this recording, the first week or so of July 2017. Friday's close shows us the price action here relative to the wheat market and the soybean market. I did not include corn, and if you take a look at the corn market, you'll see why, because it's in a consolidation. And these two are a little bit more energetic, and we can actually see an example of smart money accumulation. So dollar has been bearish, so that means higher prices should be expected in the commodity markets. Not always, not a panacea, but it should happen. But under that pretense that it may go higher, we're going to be looking for characteristics to support the idea that the grain market should go higher. And how can we do that? We start going in and looking at the relative lows across the grain complex. Obviously, we have only 3 grains to look at. It's the soybean market, the corn market, and the wheat market. I have wheat overlaid with the soybean. Now, you don't need to do this, but I'm doing it graphically so you can see what I'm referring to. As you can see, the mid portion of May going into the first week of June, wheat was unwilling to make a lower low, while the soybean market had fallen off rather precipitously. Then both rallied a little bit up into around the 19th of June, and then while both had a modest decline, soybeans made a lower low. But the wheat market failed to go lower, and you can see that happening in here. So soybeans went lower. We can see clearly here that wheat is the stronger of the grain markets. And as a result, the wheat market rallied $6,500 per contract, and the soybean market rallied $4,800 per contract. There is a built-in advantage to using visual analysis like this because it cuts to the core of whether smart money is buying or selling. Again, the general principle is if there's going to be institutions stepping in or large commercial dominant users or producers that are trying to buy a lot or sell a lot of a specific commodity, they're going to leave telltale signs in price. They have to. They can't hide it. Their sheer volume is going to create this crack. Well, when we see this occurring, we know there's a massive accumulation going on in the grain complex. Now, all 3, corn, soybeans, and wheat, can go up in tandem. There's going to be a sympathy play. Soybeans rallied significant. There's nothing wrong with seeing a $4,800 per contract move. If you were long in that, who would be mad about that? Nobody. But our job as an analyst and a developing professional trader, we want to see the characteristics that lead to us finding the strongest of the specific commodity markets in a specific sector. That way we end up with a portfolio of the strongest or the weakest at that given time. And here, in this example, we can clearly see that the concepts ferreted out the larger of the two, and that being wheat producing a $6,500 per contract move over, again, a $4,800 move seen in the soybean market. And here's those 2 respective charts in separate. You can see soybeans on the left making a lower low in June, going into the last week of June, going into the beginning of July. And then wheat had already been making higher lows and starting to build up institutional order flow. All down closed candles are supporting price in a bullish order block nature. And short-term highs were starting to break before the short-term highs were seen in the soybean market. So a lot of accumulation can be seen in this chart than that of the one on the left, which is the soybeans. So wheat was under a massive amount of accumulation, and you can see that visually at the lows. Also notice that during the month of May, we had a massive decline in open interest while wheat was in a consolidation. Then in June, we saw another massive reduction in open interest on 2 scales on wheat. And then finally, when the bottom fell out on the open interest of wheat going into the last week of June, going into July, that's all that was necessary. Price traded down into a bullish order block on the daily for wheat and then exploded and made another $1 move or $5,000 per contract for that move. It literally took only 1, 2, 3, 4, 5 of a week, about a week's worth of time to make $5,000 per contract. Who is going to be arguing about that? No, I don't want $5,000. Don't you dare give me that. Okay, seeking mega trades. Now the process in simple terms is as follows. What we're going to be doing is we're going to be searching headlines for commodities. Any headline that would spark an interest, something like the grains are in trouble because it's going to be dry, or there's too much rain, things of that nature, shortage of oil production. OPEC cuts back oil production, or there's a war. Something's looming in the Middle East. Well, that's going to affect oil prices. The next thing is we're going to be looking for markets that have a premium. Again, we don't need to have a market premium, but if it does, we're focusing primarily more on those particular markets than that of a market that doesn't have a premium. And we're going to be conferring with the dollar index for direction. Again, dollar up, commodities down, dollar down, commodities up. And we're going to use relative strength in each sector, comparing lows when we're bullish, and we're looking for the one that fails to make a lower low to be a buyer. And we're going to be looking at highs when we're bearish, and we're going to be looking for a failure swing or a market that fails to make a higher high when it's bearish. And you can see heavy distribution in that. We're going to filter each leader from each sector, and we're going to try to follow one leader from each sector. And we're going to use option prices for paper trading also. So if you think there's going to be higher prices or lower prices, the way you practice it is go into the options chain, and we'll talk about that in August as well in great detail. But it'll help you find opportunities where even with folks that have very small trading accounts, you can buy, if you're bullish on commodities as a whole, you can buy call options in just about every one of the major sectors and not spend a whole lot of money, and you have controlled risk. It's limited to what you paid for the option premium plus the commission paid. Now, this is obviously a very basic and very simplified overview that will be refined in detail in August in the PDF files for commodity top-down analysis. I say it to you here because I want you to think like this, build this mindset going in, because when we start talking about those lessons in August, at least you know a general theme or process that we work off of, that there's other portions and gaps that's intentionally left here to be filled in when we get into the PDF files for August. The commodity basket. Now, not every commodity sector will perform well, and not every selected leader will perform or outperform as expected. So due to the lack of perfection, unfortunately, I can't bridge, our diversified approach in all the sectors will, in theory, increase the odds of capturing a mega trade in one or more sectors. Now, the magnitude and energy seen in the winners will many times cover the collateral damage the underperformers will generate post-trade. Now, let's assume for a moment you've done the analysis and you've come to a leader that you think is going to outperform all the others in that specific sector for all the other sectors combined. So now you have a list of specific commodities. What to do? Well, the leaders, you can actually start comparing them as well and see which of those have much more relative strength. For instance, if we're bullish, we've gone through all the agricultural sectors and we've gone through all the financial sectors, and we come to our buy list and we're bullish. We have our leaders on the upside that we think is going to go up, but now we can start looking at those respective leaders on a comparative basis and see, if we're bullish, which one of those commodities are starting to break highs earlier than the others, because that means you can really see professional buying earlier than just the divergence at the lows that you compared with the sector members of each respective sector. In other words, if we're looking at the grain market and we ferreted out, say the soybean market happened to be the one that failed to make a lower low, and corn and wheat were unsure or unclear about what they wanted to do, and it's clear that soybeans was under accumulation. Okay, fine, we have soybeans out of that complex. And say we did the same thing for the meats, okay, or livestock, and say that it was lean hogs that was the upside outperformer that we expect to see. We can look at the highs in relative terms in the soybean market and in the hog market and see which one of those commodities, which one was breaking out above short-term highs or breaking highs, or basically bearish order blocks, before the other, and which one is seeing much more support at down close candles or bullish order blocks, basically having the strongest of the strongest. Okay, basically whittling it down even further, because that way, if you're going to have a commodity basket, you can start allocating more of your account, okay? Or if you're going to be doing options, you can be buying more options in the strongest in your leader list and still participate in all the sectors, but allocate more of your money to the strongest of the strong. In other words, if we end up with, say, 8 different leaders, we don't want to evenly distribute that allocation of money. We want to do more analysis and find out which of these 8 are in fact even stronger than their respective peers. So that 8 could be finally brought down to 3 that are really outperforming. So say 50% of your investment capital goes into those 3, and the remaining portion that you was going to allocate to this idea, then you would use that with the remaining sectors and spread that out. So that way you're focusing a lot more allocation in the ones that are showing leadership characteristics, but you're also still participating in a diversified manner in all the other sectors. So you have one grain, you have one livestock, you have one metal, you have one energy commodity, you have one food, or like coffee or cocoa, one of those from that sector. So you have a dabbling, okay, in all of the commodity sectors as a whole, but you're really allocated heavily in the ones that have been visually shown to show massive accumulation because they're breaking highs and they're failing to go lower. So if we see that in comparison to all the other sector leaders that we've ferreted out, it will build up an even stronger likelihood that you're going to catch a mega trade, because those outperforming or leadership commodities that you've done analysis even further on comparatively, you really have, fine-tuned it down to a point at which we can see most likely the strongest price moves for that calendar year. All right, the treasure seeker mindset. Now, some of you might feel perhaps this is a lot of work to find a market move, or maybe it might seem boring to sift through charts for generic conditions. From my first day looking at the annual big movers and listening to Larry Williams about 20,000 times, okay, playing his VHS cassette course over and over again, I could hear him say that he loves going through charts. He loves it. He loves doing it. And I'm not sure if I was just being programmed or primed because I looked up to him and I heard him say that. But either way, I can tell you, I love, matter of fact, I love doing the analysis and going through and finding these types of things. And I'm addicted to that. It's, to me, since the very first day, I've likened it to treasure hunting. It's like a treasure that's hidden that, I have to personally go into the charts and find. And like most anything else, if you turn it into a game, it makes it fun. So every new calendar year presents a new treasure hunt. One of the things that helps keeps me motivated is because I have this mindset that I look at the markets as that particular analogy. Like it's a treasure hunt. It's a game. It's hide and seek. They are hiding something from me, so therefore I'm going to do my best to find out what it is they're hiding, and I need to find them. Find them, being the smart money. I need to see what they're doing. I need to be a tracker. I need to be following, their footprints. I need to be a sniper. I need to be stalking them. I need to be a fisherman. I need to cast a line in the area where I think they're going to be, biting, and then maybe catch a whale. All those analogies are the same way. Whatever it takes for you, to find enjoyment out of this, that's what it needs. That's what needs to happen. If you look at it as a daunting task, or if you like, this is a lot of work, and even I don't even want to trade commodities. If you think that, then you're going to hit a plateau in your understanding and your analysis. Even if you don't agree with me now, trust me, you'll want to come back to this whole month's content, because it's going to lend well to your overall analysis, because you want to be finding these big moves. It's one thing to be a position trader, okay, but if you can find big moves that's going to happen in magnitude and in short order, in other words, real quick, fast moves, not that they complete real quick, they just cover a lot of ground fast. That's what these mega trades look like. And I'm purposely avoiding a lot of examples because I'm going to have a live session with you, you know, in the beginning of the week where I'm going to give you homework to look for specific things. And if I waste the exercise here in the teaching, I steal and rob you of the opportunity of learning by you going into the chart yourself. So I'm going to give you some insights at the beginning of the week to look for something, and then we'll go over it and review it again. So your homework for now, because there's going to be 2 homework assignments, one because of this recording lesson, and then on Tuesday I'll give you another homework to do for Thursday's recap. So your homework is, with the benefit of hindsight, I would like for you, and I'm encouraging you to look at 2016. Study the big movers in the commodity markets in 2016. See if you can see these things that's being described in this lesson. We're going to be reviewing 2016's examples this coming Friday, and I'm going to teach you how to go back and look at previous data and old charts to pull up the information. But some of you may not know how to do that now. That's okay. Just look at a weekly chart. Okay, go through all the commodities that's been outlined here, and I purposely kept the commodities that are currencies and interest rate out because they're going to be respective lessons in this month as well. But we're going to go through a live webinar on this coming Friday. We're actually going to go through all of the big movers from 2016. But until then, I want you to go through and find out as much as you can by way of price action which movers took place last year. Couple it with the dollar index. Okay, whatever insights you can glean from hindsight with the dollar, whether going up or down, it's going to be an inverse relationship that you're going to be looking for. And then look for each sector's biggest mover. Okay, and see if you don't see these characteristics seen in those respective sectors. And I want you to not be bored. I don't want you to think about it like, oh, this is not going to lead to anything. I'm a Forex trader. I promise you it will get you to another level of understanding about what the market's doing, why it's doing this, because there's also going to be currencies that do these types of things. Right now, we're just talking in general terms about commodities as a whole. I've removed the currencies as its an individual sector. I've removed the bond market as its own individual sector. I've removed the indices as its own individual sector. Okay, so when we talk about stocks, that's going to be also one that's a lot of information. But for this particular lesson, I want you to look at all of the big moves that took place in the year 2016 in the commodities market. Go through all the grains, which are those 3: corn, soybean, and wheat. Go through the meats, which is live cattle, feeder cattle, and lean hogs. Look at coffee, cocoa, sugar, orange juice, and cotton. And look at gold and silver. Look at heating oil, crude oil, and see if you don't find nice big moves that are very clearly shown by professional accumulation or professional distribution by way of price action and you simply using the dollar index. Now again, we're going to build on this in August. I'm going to give you a step-by-step procedure where you go through each thing to look at, and if it doesn't have that information, you're going to wait for more information. Or it may take you to go back to the previous stage and you wait. And you're going to find that there is a methodical approach to doing all this stuff where it seems fragmented right now. It's okay because I'm leaving things for your discovery that you'll find in your actual exercises. And like this homework, by you going through and looking at it, invariably some of you are going to not come away with anything fruitful. And that's okay, because when we do the live session and I break it down, you're like, oh, okay, I got it. Some of you will be pleased to see that you see the same thing that I'm going to pull out in our live session. And that will be another milestone for your confidence and your growth. But even if you think you're never going to trade commodities, and that may be true, and I'm not trying to twist anybody's arm here to trade commodities, go through this process, go through this procedure, because I promise when you do it, it will build a greater understanding about the market, price action as a whole, and you as a trader. So get into those treasure maps, or price charts as we call them, and find those big moves that took place in 2016, and we'll talk about them in a live session this Friday coming up.